Good morning and welcome to this Monday, February 1st, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, futures kind of turned around. Looked like last night we were going to be off to maybe another shaky start. But we have seen things pick back up again. Currently, we've got the Dow futures up a couple hundred points, S&P 500 up 34, NASDAQ up about 140, NASDAQ leading in terms of percentage. On a percentage basis, up a little bit more than 1%. The others down or up a little bit less than 1%. Earnings continuing to pick up. So we're going to have a lot of companies reporting this week, hundreds of companies, things really starting to heat up. A lot of the big companies report in the first couple weeks. So normally when that first calendar month of the calendar quarter ends, so usually the January, April, July, and October months, once they're done, you kind of gotten beyond most of the really large companies. There'll still be some, but many of the Dow companies reported and so forth. But we do have some big reports coming up this week. Tomorrow we've got Amazon and Google. Obviously, they're going to be very closely watched. But the number of companies, we start moving on to the second tier. A lot of the second tier technology companies, some of the companies that maybe a lot of traders sitting on pins and needles, not quite sure what to expect. A company like Peloton, $42 billion company. Is that too much? Have they, can they substantiate the kind of value that's been placed on them? Are they continuing to grow? A lot of things like that. A lot of questions I think will be answered over the next couple of weeks with all these additional earnings reports coming out. Let's go ahead and start. We'll take you over to our page. We had a great session on Saturday, by the way. We did a webinar, and actually it was over 3 hours. It's one of the longest webinars I've done. And on the one hand, yeah, it's probably a long webinar. But on the other hand, first of all, it was recorded. So, you can come back and look at it anytime, and it was free. You can go over to YouTube and search Earnings Beats. You should be able to find it over there. If not, and you want a copy of it, you can write us at support@earningsbeats.com. We'll be sure to get that link out to you. But essentially what we did is we walked everyone through our service, and we've added so many features over the last 18 months. It's kind of been a whirlwind. Some of those features were added as a result of the pandemic, just some of the things that, folks were at home or working from home and so forth. So we tried to cater our products and services somewhat around that and try and help folks through what was a really difficult year. But anyway, on Saturday, we went through and talked about all of our services and products. I mean, literally one by one, down every line item on our navigational panel. When you sign in, you'll see all of our services going down the left-hand side of the page. And so we went through all of those and then kind of took it a step further and talked a little bit about the products, how you can use them, how you can use different products together, different scans, and that sort of thing. So I think it was a really useful webinar. We got a ton of tremendous feedback from it. And I think it'll help, especially those who are new to our service and really don't know much about what we do at Earnings Beats, or those who are on trial, who are trying our service. I think it was a timely event, certainly for those folks. Anyhow, here on our homepage, if you're not familiar with Earnings Beats, if you're new, I'd love to have you join us through our Earnings Beats Digest. It's a free newsletter, no credit card required. You can unsubscribe at any time. I always say you're not going to hurt my feelings. We're trying to give back to our community through this free newsletter. If our style and what we do isn't, you don't feel like it's a match, that's fine. But I do think that we provide a lot of really good, valuable information and at no cost to help you begin to understand a little bit about how we look at the market. But all it requires is your name, email address. We'll get you set up. I did a company this morning. It's a cybersecurity software company I talked about. Not one that I think is going to do particularly well because it's not been a very good relative performer. So Wall Street obviously is not expecting a whole lot out of the company. But if a company like that can perform well or at least report better than expected results, then I can only imagine what some of the better cybersecurity companies are going to do. And this is a group that's been moving pretty well for these last couple of months. So I'm looking forward to a lot of these earnings reports. So I simply pointed out in the newsletter, hey, let's watch this one first. Let's see what happens. They report tomorrow. But those are the types of things that we talk about in the newsletter. It's usually just a very brief article, won't take much time out of your day. Maybe it's a trading opportunity, and so forth. One of the key features of our service, and really it kind of brings everything that we do at Earnings Beats together, is our portfolios. I mean, our portfolios are selected from our chart lists. Our chart lists are generated from all of our research that we do, both fundamental and technical. And then we pick the best of the best, leading stocks and leading industry groups, and they go in our portfolios. We update this every day, but you can see the performance of all of our portfolios. I think they've been outstanding. We're really proud of these results. And it's more about teaching than it is the results. It's about showing folks how to look at the market differently. Don't follow what you're hearing on CNBC. I can't stress that enough. They're looking for clicks. They're looking for anything to drive viewers, either to their shows or to their articles, whatever, because that's how they can advertise. The more folks that are there, their big money comes from advertising. So they're not trying to get you there so they can teach you something. They're trying to get you there so they can make money. It's pretty obvious when you sit down and think about it. Anyhow, check us out. If you do want to start a no cost trial, we'd love to have you. We actually have our stock selections for each of our portfolios. They come out quarterly. We hold them 90 days, no exceptions. And then the next quarter, we pick new stocks. But this all comes up February 19th. We're only 2 weeks away now. So if you're interested and you sign up for a trial, you get 30-day free trial. That'll cover the next selection. So this is a great time to give us a shot and hopefully kind of change the way you look at the market. If you haven't been doing well in the market, then you definitely should give us a shot. All right, let's move on. Action on Friday. It was not a good day. No way to sugarcoat that. And the market's kind of been looking like this for the last week or so. I mean, talked about this maybe early last week and maybe even the tail end of the week before, how money was rotating back into defensive stocks, even though the market was trying to go higher. I mean, right up in here as we were near highs, started seeing more money rotate into defensive areas. So that was a little bit of a clue. I mean, that's not going to, 1 or 2 days of leadership from defensive groups. That's not, a long-term top. I'm not trying to say anything like that. It's not even enough really that would drive me, say, to move to cash. I wasn't seeing enough signals, not like I saw back at the beginning of September. So you want to ride it out, but it's also not a bad idea maybe to take a little bit of profits here or there, have a little bit of cash, just in case, so that when opportunities present themselves. One of the worst things is to be fully invested and then see a great opportunity come up. And then you're like, well, I don't want to sell this stock and I don't want to sell this stock. This stock's pulled back a little bit. I don't want to really get out of it now, but I'd really like to get into this other stock. And those decisions are made a lot easier if you're willing to take profits. If you're a short-term trader or even a swing trader and your stock gets up close to resistance, I know you think, okay, it's going to break out. Here we go. But taking some profits near resistance, and I'll give you a perfect example. I sold Apple at about 140, 141. It went on to 144 or whatever it was after earnings or right before earnings. So it had made that breakout, and it kept moving up, but it freed up some cash for me. And then after earnings, Apple came back. I ended up getting back into Apple in the low 130s. So having some cash available just gives you the flexibility. Don't worry about, is this stock going to go up higher? There are thousands of stocks out there. You don't have to have that stock. At least that's the way I look at it now. Anyhow, looking at the action here last week, the Dow, S&P, NASDAQ, all of them rolled over. Mid caps, the only one really that's hanging on to its 20-day moving average, and it actually closed slightly below it, was the S&P 600 small cap index. You can see right here, closed just below that 20, but all the others lost the 20, and the Dow and the S&P both lost their 50-day moving averages. S&P barely, and the Dow a little bit more. I mean, the Dow's back down under 30,000. But and I'm going to go through this in just a couple of minutes with talking technically, so I won't spend a whole lot of time here. But sometimes we get so caught up on the daily charts that we don't keep in mind the big picture. When the daily charts start to break down, go below moving averages and so forth, I don't think bearish thoughts. What I think is consolidation. Now, if we continue to trend higher, we should be looking at prices remaining above that 20-day moving average. When we break below the 20-day moving average, that just tells me maybe we're in for a little bit more consolidation, not just a little pullback, but maybe a little bit more consolidation. And so it's just a different approach to the market. I'm not going to be nearly as anxious to go jumping into positions because now we're trading below the 20. We're actually below the 50 on a couple of these. You know, and I had said before on the S&P, we could go back to 3,600, 3,650. That wouldn't change anything in my mind as far as long term. Short term, yeah, you kind of, it makes it a little bit more difficult because you're going to see a lot more rotation, a little bit more selling in some areas than you would have expected. But overall, it's not necessarily an unhealthy thing. We'll talk about that more in just a bit. Energy, these were the 5 worst performing groups on Friday. You can see energy down 3%, technology 2.3%, discretionary 2.3%, industrials 2.2%, staples 2.1%. It was pretty much across the board we saw selling. Again, nothing horrible, but we did on some of the key groups like technology and discretionary, we did move below the 20-day. And you can see over the past few months, that has not really happened. So the selling was definitely more and was deeper than what we've seen recently. But as I'll show you again in just a minute, really not that big a deal in my view. 10-year Treasury yield, let's get a quick update here. We do have, or we will have some economic reports out. January PMI manufacturing is due out today. The estimate's 58. December was 57.1. So we are expecting a little bit of an increase there. However, January ISM manufacturing, which last month came in at 60.7, is expected to drop to 60.0. So a little mixed picture there, but both numbers are pretty good. I mean, 58 and 60 on the manufacturing, not bad. So I think we're seeing some increased activity in terms of manufacturing. I think that's good for the market. Construction spending, I don't really pay much attention to this. Comes out at 10 a.m. this morning. December construction spending. First of all, we're in February. So, you know, the market looks forward. So how much good is it telling us what happened in construction spending in December? Not a lot, in my view. Anyway, it's expected to rise 0.8%. November, the prior month, had risen 0.9%. So I'm expecting, you know, number in that general vicinity. But again, if we had a big miss, I don't think the market, I think it would be a big yawn on Wall Street because that news is so outdated. I'm more, you know, focused on new home sales, existing home sales, housing starts, building permits. I think those give us a lot more of a clue than December construction spending will give us in February. Anyhow, 10-year Treasury yield, when you look at it, when we made this move up, remember we printed that black filled candle, and we started pulling back. That's a topping sign if you follow candlesticks, and especially off of a big move to the upside like that. And we went right back down. When we were going down, we wanted to look at 2 areas, that rising 20-day EMA and both psychological and gap support on the yield, which is right at 1%. And we went right down, hit 1% middle of last week, and now we're rallying back. We're at 108. I don't think we're going to go taking off. In fact, we could probably consolidate quite a bit here, kind of like we did back, you know, when we topped in November with the vaccine news, and then we just kind of went sideways here for a month and a half, almost 2 months. That's kind of what I would expect. I would say 117, 118 is what I would expect to the upside, is kind of a boundary there. And to the downside, I think we could go as low as maybe 0.95. I don't know if we'll go below 1, but I wouldn't be shocked if we went a little bit lower. But when you consolidate on the yield, that tends to be a little bit more difficult for stocks to rise, because when the yield is moving up, that means the treasuries are being sold. And so money rotates out of treasuries and into equities. There's a long-term positive correlation between the direction of the TNX, 10-year treasury yield, and the direction of the S&P 500. positive correlation. So when the yield is going up, generally you're going to get a good market, good stock market. When the yield is consolidating or moving down in a bear market, when the stocks, like if you go back to 2007, 2009, when you get a pullback in the yield, money is going into treasuries, it's coming out of stocks. You'll see big drops in stocks. In a secular bull market like we've been in, when you see pullbacks in the yield, the market tends to stumble, but it doesn't fall. It consolidates. Maybe we get a little bit of downside action, but generally speaking, over a period of time, the market does fairly well, even though yields fall. Anyhow, let's move on. Let's talk a little talking technically. So first thing I want to do, everyone's all up in an uproar over last week's action. Is this it? Is this the top? I don't believe so. I mean, nothing is a guarantee. I can only tell you what I feel about the market, but I believe this. If a trade war with China and to some extent with Europe and other trading partners around the globe doesn't take this market down, and a 100-year pandemic, healthcare crisis with our economy shutting down for a month and being very restricted for the last year, that doesn't take down the stock market, do you really think a bunch of Reddit investors, traders, are going to take down this market? Do you think that a few hedge funds that get burned by this move to the upside in some of these heavily shorted stocks, you think that's taking the market down? It's a nice headline, sounds good, scares everybody to death. But, VIX, we'll talk about the VIX in a little bit. I mean, VIX up to 37 on Friday or whatever it was based on that news. Listen, if hedge funds, hedge is in their name. If they're shorting and they're not protected on a move to the upside, I don't know why anyone should feel sorry for them, to be honest. It's nothing for a hedge fund to heavily short a company into oblivion, sometimes driving companies out of business, losing jobs. They short them heavily and then go on CNBC and tout their positions. And then, of course, that just adds to the selling fury. I mean, wouldn't it be nice if we all could buy a stock or sell a stock and announce it on CNBC and have everybody follow us? That would be wonderful. That's what that's what we see with, Bill Ackerman, who's, with Pershing Square or whatever, the hedge fund. He throws his muscle around all the time on CNBC, which I think personally is wrong. I think the SEC should prohibit that in some fashion. I mean, when you're talking about shorting and you've got that kind of influence on the market and you're going to go in and talk about it on CNBC, which helps your position, I don't know. To me, there's conflict of interest. Something shouldn't happen. But now we've got the flip side, and now we've got individual investors kind of pooling their money. What's the difference? You got hedge funds pooling money from all over the world and then taking huge bets on a company. What's the difference between what they do, which is completely legal, and now what they're doing at Reddit, which is just more of a disorganized grouping of people coming together and pooling their resources and doing some, investing together? There's no difference. But now all of a sudden, Wall Street's all upset. They need some regulations. Give me a break. I could go on and on about this, but listen, if you've got a hedge fund and you've got, 10% short interest in GameStop, did it ever cross your mind that the stock is shorted to the tune of 140% of float? Did it ever cross your mind that if this stock were to actually catch fire and go to 10, 15, 20, 40, 50, what that would mean to your short position? Did you ever think about maybe going out 6 months, 12 months and buying some out of the money calls to protect yourself? After all, you're a hedge fund. Why aren't you hedging? The fact that this is happening and is taking certain hedge funds under, to me, is just irresponsible behavior by the hedge funds. If I had my money with these hedge funds and they were making that kind of a bet and they weren't protected, I'd be seeking legal advice. I mean, it's ridiculous. And now we're going to feel sorry for them? Sorry, I'm not. Anyhow, I could go on and on and on, but my point here is it's not, the market is made up of trillions and trillions and trillions and trillions and trillions of dollars. a few really bad bets by certain hedge funds and having to sell some stocks to cover their bad short positions is not going to take this market down. I mean, I don't, it's not like banks failing because they're all intertwined. And, you start taking some of those banks down like we saw in the financial crisis. Yeah, that was scary. I don't, maybe I'm off base here, but I don't think $100 billion of losses by hedge funds is going to trigger any kind of tsunami in the market. Sounds good, makes for good headlines, lots of clickbait, but I just don't see it happening. I think this market's a whole lot stronger than that. But I guess we're going to find out over time. Anyhow, look at the S&P 500 on a weekly chart. Now, if we go to the daily chart, granted, hey, this is the first time we've been down below the 20-day in the last 3 months, closed just below the 50-day. We've only done that a couple of times throughout this whole move. Oh my gosh, and if you look at the Dow, the break below the 50-day is even worse. Oh, DJ. I think I'd get that right after all these years. But the Dow here moves down below the 50-day moving average, and it's pretty clear it's down below the 50-day moving average. And we've only seen that twice, since we moved above the 50-day back in late April. So yeah, I mean, short term, this is something I haven't seen very often. So that means bad things, right? Well, again, perspective is important in the stock market and when you're looking at different things. I mean, when you get these moves to the upside and you're in a nice channel moving up, pullbacks to the 20-week EMA are kind of normal. And if you fail and you go down below the 20, a lot of times you'll test that 50, kind of reset your PPO at the center line, and then you move up again. Now, we've had two really bad periods over the past probably last 6 years. One of them was right here, fourth quarter, 2018 trade war. VIX shot up. That was going to be the end of the market. It wasn't. Then we had a really big shocker with the pandemic. I mean, the trade war was something that we had been talking about and so forth. The pandemic just kind of hit out of the blue. Now, we did know that there were cases in China as early as, January, but there was a lot of questions, would this be, something that, didn't really do a whole lot. Is going to be the swine flu, or is it going to be, well, it turned out to be something that was pretty highly contagious and went around the globe, and a lot of folks passed from it. And so as we started learning more about it, the panic really began to set in. And here we are a year later, beyond the highs before that panic even set in. This is what a secular bull market does. Just like 1987 market crash, we were in a 20-year secular bull market. Yes, the crash was painful. I remember it was one of my first experiences really investing in the market. I graduated college in 1983. So I was just kind of getting my feet wet, thinking, oh, market's going up. I'm good at this. And then 1987 hit, and I was like, okay, I'm not so good at this anymore. And that's what a market will do to you. So you have to understand what secular bull markets do. And I think we've had a really nice reaction off of those lows moving to new highs. And again, could this be short term, maybe even intermediate term weakness? Of course, I don't believe it's long term. I don't even believe it's intermediate term. I think it's a pullback, a short term pullback. And then I think we go to new highs. But as you can see on the weekly chart, we're not even down to test the 20-week yet. And the fear is already off the charts. I mean, 37 on the VIX. Let me show you. Let's pull up a long-term chart on the VIX. And let me do it on this chart. So let's go back. Well, we'll do weekly. We'll do weekly candles. Let's go back 20 years. Don't need the volume. And let's put in the price action on the S&P. Don't need the PPO. Oh, and I don't need moving averages. So let's get rid of that. All right. Now, if you look at the spikes over the last 20 years, I mean, you can see the two big ones. Financial crisis, 100-year pandemic. Pretty hard to get that kind of pessimism and fear in the market. If you look beyond those extremes, because those extremes were extreme. I mean, if you look at major market bottoms, anytime you get a VIX in the 30s and especially in the 40s, prior to 2008, 45 was kind of like, that's where the bar was in terms of the VIX. 45 was like, wow, crazy panic. Bottom of the 2002 bear market from remember dot-com bubble? Companies like Cisco going from 70 to single digits. That was pretty scary. 45 was as high as we ever got on the VIX. Financial crisis, we never went through 45 until we started watching banks fail. You got the Bear Stearns, Lehman Brothers, all of that. And it's like, then we really raised the bar. Then we had some, what I would call like aftershocks, where we got up into the 40s again. But 2015, when we had the weakness in the market here, we got up to briefly into the low 50s. 2016, when we were breaking down, we only went to 32. That was, a year and a half low. And I actually was starting to turn a little bit bearish there on that breakdown because there were some other signals that I was a little concerned with, but we ended up coming right back up and strengthening. Then we go into 2018, when we had that initial move down back in the first quarter, we spiked to 50. The trade war, all of that fear, 37. The pandemic, then of course we went back up in the 80s. But here we get a bunch of Reddit traders and we're at 37. We're already near major peaks in fear. That's the thing that I think is still so bullish about this market, is despite everything we've gone through, setting new highs, all-time highs, people are still fearful. There are a lot of people who do not believe in this market, which I actually like. I think it's great. I mean, everybody I talk to, just people I know, I walk up to them, they're like, man, should I get out of the market? I don't, this is what's going to happen. Now we got hedge funds, failing. This is awful. Market's horrible. We shouldn't be up here. That's the mentality. When you have to worry is when everybody is, cheering at one another because they're making so much money in the stock market and they have no idea of what can happen to the downside. When we get to that kind of complacency, that's when we need to worry. Anyhow, I spent a lot of time on this, but I think it's pretty important because, again, VIX at 30 in the mid 30s does not happen often. I know we're coming out of this pandemic. And so we're getting these aftershocks, and I think we'll still get some more. But I just don't see a whole lot of selling. Look at where we are. We're almost at the all-time high. We had a little bit of selling last week and 37 on the VIX. People don't believe. Again, we'll see what happens. I also want to talk about biotechs, because you look at the biotechs, and I know when we pull up the daily, because I made a long-term call on biotechs that we were going to 2,900 back when we broke out at 2,200. And we've seen some pullbacks. I mean, from July all the way down here, I had plenty of emails and questions come up. What's wrong with biotechs? They haven't really done what you thought they would do. And well, it takes time. I mean, you go through periods. If you look at a monthly chart on the biotechs, you see this huge move up. You see the pullback, double top, pullback, again, tops. If you draw a line across here, equal highs, higher lows, you got an ascending triangle. When we broke out above 2,200, the measurement was 2,900, from 2,200 down to 15, which was the low. You take those 700 points on, add it to 2,200, you get 29. If you look at the monthly chart, you wouldn't say what's wrong with biotech. You'd say, oh, they're still in their uptrend. It's all about perspective. You get in the daily chart and you get so caught up in the daily chart and you think biotechs are horrible because for 2 or 3 months, they don't do anything while the market's going up. They rest. They rest back to that rising 20-week moving average. And now look at them. Now they're back on the move. Now everyone's starting to get interested in biotechs again. There was nothing bad that ever happened to biotechs. But again, we get caught up in the day-to-day. All right, market's getting ready to open. I do want to just talk about, I do a monthly short report. Everyone so much stuff going on now in the news about, these shorts and GME. Everyone's a GME expert now. But, we've been talking about shorts and our short squeeze chart list that we keep. We've been updating for members for months. And last month, January 3rd, I issued our very first short report, which is a monthly report that we're going to send out. And I just sent out the second one last night. So you should have the February short report. If you're a member and you haven't gotten it, check your email. You should have it. But the stocks that I mentioned, I just want to go over these because these were the 10 that I gave out on January 3rd. Not after the moves were made, but these were, we were already concentrating on short stocks. So AWH back here at the beginning of January was 671, went up over 10. And you can see this starting to move, volume picking up. That was one of them we gave. PGEN actually is the only one that's down. Of the 10 that we provided last month, this is the only one that's down. They came out with a secondary offering, by the way. But I still believe this one is in play from a short perspective. DDS, this was 63. It's now 87, went up to 130. FUBO, Fubo TV. On January, at the beginning of January, it was 28. Today, it's up another 13.5%. It's at 48. Stitch Fix was 58.72 down here. It went all the way up to 110, over 110, currently at 95.04, up about 62%. Chewy, 89, almost $90. It's currently at 103. Nordstrom's was 31.21. It's 35. GME was on our list of 10. It was 18.84. Right now it's at 302. Pretty good gain there. SunPower, SPWR, 25.64. Right now it's 53.66, more than the double there. And BGFV, which was 10.21. It is now 13.42. And so the average of these 10 stocks, if you just went out and said, hey, I'm going to take a shot, the average of these 10 stocks, 196% you'd have made. Now, granted, GME at 1,600% is inflating those numbers, but even pulling that one out, I mean, I don't know what the average is, but I bet it's somewhere about 30, 40%. But that was all the short. I mean, that's what a short squeeze is. If you're a trader, you need to be aware of what a high short percentage of float means to a company when you start to see breakouts. GME is not a shocker. I wrote about it on September 2nd, said this could be the mother of all short squeezes. I think it's probably been that. That was back on September 2nd. So it's not that, the problem is you just need the breakouts. You need to start to see the shorts feel the pain of being on the wrong side of the trade and having unlimited risk. When you buy a stock, you put $10,000 into a stock, the most you can lose is $10,000. That's the most you can lose. When you short a stock for $10,000, you could lose 20,000, you could lose 50,000, you could lose $1 million. Ask the hedge funds how much you can lose. I mean, that's the scary part. It can ruin people. And so if you thought March was panic to the downside, imagine the other side, where you now, not only is there panic and unbelievable movement. I mean, look at GME. That's just a poster child. Talk about panic. I mean, we went above 20 2 or 3 weeks ago and hit 500. That's pretty crazy. Anyway, let's go talk just briefly about earnings. Not really a whole lot out today. What I will say is this. Earnings so far this earnings season have been spectacular. So why is the market not pricing it in? Well, it already did. We already had a move up. We have buy on rumor, sell on news. That's been around Wall Street for as long as I've been involved in the market, probably ever since the Wall Street started. some people have news that we don't have. Wall Street, like it or not, can talk to management anytime they want. They can schedule meetings, find out what's going on in the company. If I pick up the phone and I call Apple, I don't think I'm getting through to the accounting department. I'm just saying. But Wall Street is. And why? Well, Apple wants their stock bought, and they know Wall Street's covering their company. And so the best way to get information out is through analysts who also work for firms that buy and sell stocks for themselves and for their clients. Now, we don't have the privilege that Wall Street has of calling companies, but we do have the privilege of being a member of stock charts and being able to pull the charts up and see where the money's going on a relative basis. That's almost as good as being in the meetings with Wall Street. That's the beauty of technical analysis. That's what our portfolios are founded upon. That's a basic principle. Wall Street trusts management teams that deliver results, beating expectations, raising guidance. That's where the money goes. And you see it on the charts. You see it in relative strength. Anyhow, Thermo Fisher reported this morning. I mean, so far, the last 10 days, which is 2 weeks of earnings, I went back and looked at them, companies beating versus missing. 286 companies over the last 2 weeks with market caps over $5 billion. So good sized companies, 286 beat their revenue or their earnings estimate. Only 40 matched or missed earnings estimate. And of those 40, I would say 10 to 15 matched. So we're talking about maybe 20 to 25 companies, maybe 10% of the companies out there missed their earnings estimate. I looked this morning, TMO beats, Nintendo beats, Otis Elevator beats, Ryanair beats, On Semiconductor beats. I mean, literally 5 for 5, over 5 billion. And the numbers, Nintendo estimates $1.10, came in at $1.64. Even Otis Elevator, 59 cents, coming at 66. That's more than the 10% beat. Ryanair lost $1.62, but still that's 33 cents better than the $1.95 that was expected to be lost. I mean, I could go on and on, but anyway, TMO, you can see, did make a move up, trying to make this breakout above the November high. We'll see, but earnings have been strong. Earnings are going to support higher prices. Earnings growth and low interest rates, you can't convince me that this market's not going higher. In my background as a CPA and in public accounting and doing valuations, there's no way that these companies are overpriced given their earnings growth and giving low interest rate environment. And especially when you consider the alternatives of investing, where else are you going to go? So you'd rather put your money in a 10-year treasury yield, getting that 1%, 1.1%. That's quite a pop. There's nowhere to go. Money's going to keep going into the stock market. It's not just the U.S. stock market, by the way. It's going to be global stock markets. They're all going higher. All right, 3 you must see. Let's go real quick. Amazon. Amazon will be reporting. These are all companies reporting tomorrow. Amazon making a nice little move off. It's been consolidating. I'll tell you, if we get a good report, maybe we get a breakout on Amazon. That could be a big boost to the NASDAQ. Google also breaking out recently in that internet space. I like internet stocks. We pulled back, but I think we're going higher. Google up almost 2% today. Nice move there. And then lastly, Amgen. Now, I talked about the biotechs earlier. We tried to make a breakout. I didn't really look to see what the news was, but we failed in that breakout, pulled back to the 20. I actually think this isn't a bad spot on Amgen. The only problem I have with Amgen is I think you have better biotechs. How about Illumina? Let's end with this one. So Illumina, look at the breakout here. Look at the accumulation distribution and look at the relative strength versus biotechs. That's where I'm talking. Do you want Amgen or do you want Illumina? Wall Street wants Illumina. I mean, I guess I can go against Wall Street and take Amgen. I think Illumina is the better play. Anyhow, that's it for today. Appreciate you tuning in. Be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. Have a great day, everybody. Happy trading.